Michael, thanks for joining us this morning. And
Thanks for having me.
This is a little bit unique because normally these videos are with listed companies. So I guess the best place to start is for you to tell us a little bit about private equity. You know, it's been around a long time and it's certainly an exciting asset class, but lots of investors might not know a lot about it. So should we start there?
Yeah, no, I think that's a great place to start. Thanks for having me this morning. Look, you know, private equity's been around, like you say, for a very long period of time. We generally kind of mention private equity, but it's really, you know, things like family-owned businesses, founder-led businesses, and it's really a parallel universe to what you see in public equity. So, you know, don't think that it's anything magical or mystical about it. Really, it's still equity at the end of the day. It's just that it's in a very private context, and it takes kind of a variety of forms, from everything including venture capital, which is kind of emerging companies trying to get new businesses, new technologies kind of commercialised and into the market, through to really mature businesses that are looking to change control. So it might be what we call a management buyout. So management team looking at a business and saying, we want to take this to the next level, and getting support from a private equity firm to really kind of take that business to the next level. So it might be, you know, ownership of a division out of a public company, taking that into a private context. It may be a family looking to sell their business and move on to the next generation, you know, kind of sell down maybe 75% of the equity to a private equity firm, maybe have management in there for the other 25%. There's a broad range of strategies, structures, opportunities that come in private markets, and it's really, you know, kind of the public equity market, the way to think about it is really just the tip of the iceberg. It's really a small part of the overall GDP of a country, the economy of a country, and private companies are probably what we more interact with every day. SME businesses, family-owned businesses, and founder-led businesses. So, you know, private equity is all around us. It's kind of relatively unique as an asset class, and relatively new, particularly for parts of the world outside of the US, but increasingly relevant. And you know, what we're seeing more and more is private equity becoming a bigger part of people's portfolios. Really kind of, you know, because there's access to investment opportunities you can't get from public markets. And then also the diversification and the lack of volatility that comes with owning things longer term, where it's really driven by earnings rather than sentiment on a day-to-day basis.
So those characteristics aren't poles apart from the listed market, it's just that, you know, maybe some of those names are not so familiar because they're not in the public eye as often.
Equity is equity, whether it's public or private. And
Absolutely.
so, you know, kind of the way to think about it is it's still an equity investment in a company.
Sure.
You're still taking the same risk around the economy, around management team success, around, you know, product development and the like, but it's in a private context.
And tell us a little bit about ROC. You know, where did you start? How long have you been around, and what's made you so successful to date?
Yeah, so ROC Partners has been around for quite a while actually. It's now kind of coming on to 25 years in various guises. The business started in Macquarie Bank, and in 2014 I led a management buyout out of Macquarie Bank. So I'm kind of living in the private equity dream myself. Well, I'm literally doing a management buyout. But I started in the private equity industry in the kind of mid-90s, and really kind of it was at the advent of private markets investing for a lot of Australian institutional investors, really on the back of interest in what was .com 1.0. So if people think back to the 98, 99 .com era, we had a lot of Australian institutional investors come to us and say, we want to get access to venture capital and this new asset class called private equity. And since that time, we've really grown the business on the back of a lot of Australian pension funds. As the pension industry in Australia has grown, we've grown with them. And then increasingly, we're seeing more and more demand for private equity types of investing in the high net worth space. And so over the last 5 years, we've really seen an acceleration of our business in the high net worth channel. We now have just under $10 billion Australian in assets under management. We have investments all around the world. We have investors all around the world. And we continue to develop new product and new strategies around private market opportunities. So we have a private credit capability, we have a private equity capability, we have a food and agriculture capability, all with a view to taking advantage of niches in the private markets that we think can generate outsized returns to investors.
So this next question, we're not going to do it justice on this video, I'm sure, but can you give us maybe 2 or 3 top sort of things that come to mind of what makes a good investment for you?
Yeah, no, it's kind of, if I snapshot into kind of 4 key areas, I think it's really strong industry. Kind of, it's always easier to run downhill than kind of run uphill, and with the wind rather than against the wind. And so if you've got an industry that's growing at a rate of growth that's greater than GDP, you should be able to generate good returns in that industry. The next piece is really management. At the end of the day, private equity investors are investors. We're not actually executing on the strategy of those businesses. So we're really looking for strong management expertise. Have they done it before? Can they generate returns for investors? Do they understand the industry? Do they have the contacts, networks, relationships that allow us to execute on the business plan we have for that company? We're looking for strong margins in these businesses. Strong margins are a proxy for a business with barriers to entry, with great operating metrics, with a real kind of reason to win. And so we're looking for businesses that have a margin that kind of is better than the rest of their industry that they're operating in. And then finally, it's alignment of interest. Like at the end of the day, the private equity model works because investors, private equity managers, management teams are all aligned by having skin in the game. So the investors putting money in, the private equity firms putting money in the deal, and then management teams putting money in the deal. So we actually own it. We've got skin in the game. Yeah. And I think that can't be underestimated when you're looking at kind of how you invest is, do the management team have real kind of, does it keep them up at night if things are going badly? Because they've got a mortgage and they've put money in to the business to kind of generate alignment with kind of what they're trying to achieve for the company. So I think they're probably the 4 key areas we look for, and if we can tick all those boxes, generally we've probably got more chance than less of winning when we're making an investment.
And I want to pick up on your point around strong management teams, because that's one that I guess in the listed space sometimes can be a little underappreciated. So obviously when you're looking at that and you're looking at the management teams, do you go and, after you have made an investment, do you sit alongside those management teams? Do you have people within your firm that sit on the board and help shape some of that strategy?
Yeah, no, absolutely. And I think, kind of one of the key, kind of aspects of when we're doing diligence. So, for a private equity deal to get done, it's at least a 6 to 8 week process. Yeah. And during that 6 to 8 week process, we're really spending a lot of time not only understanding the business and the financial metrics of the business, but also kind of working with management. And are these people we can work with? Are these people honest and trustworthy and capable? And we're making that assessment. And in a lot of cases, we're talking to management for 6 months, 12 months prior to a transaction actually happening. So we get the opportunity to really get to know a lot about those individuals before we actually commit to, in essence, getting married for the next 5 years. Yeah. So we spend a lot of time with management beforehand. We use our networks a lot. I think this is the other piece that private equity does well, is trying to kind of work out, who's this person worked with before? Is there someone we know and trust that we can ask for their view on the individual? Sure. Where are the gaps in the management team? So if we need a new CFO or a new chief operating officer or a new sales manager, who in the industry kind of broadly that we know can we bring in to help supplement the management team? So we're doing all that analysis beforehand before we even do the deal. Once we're in the deal, we're generally talking to the management team at least weekly. For the companies I'm involved with and sit on the boards of, I'm talking to management at least 2 or 3 times a week, checking in, how are you going? Because I think, and this is not dissimilar to public company context. I think being a CEO is a pretty lonely spot.
Absolutely.
You've got the board kind of coming down asking you, why aren't you delivering? Yeah. And then you've got everyone underneath you kind of looking for leadership and asking, what's in it for me? And so that CEO role, I think having that engagement with the CEO where they feel like they've got a sounding board, someone that's on their side in terms of understanding, okay, I'm thinking about doing this with the business, what do you think? And really bouncing ideas off each other is really a key kind of part of the private equity model. And then obviously, we take board seats as well. So we have that corporate governance overlay of having board seats. We're obviously officially kind of informally meeting on a monthly basis in those board meetings. Yeah. But it's more that day-to-day interaction that's really important. One of the big things that private equity does well is it moves quickly. We're not hamstrung by having to bring boards together, by having to bring external shareholders into our strategy, if we decide we want to make a decision, we can do that really quickly and move forward on that basis. So that I think is kind of part of how you engage with management and make sure that works well.
Sure. And I want to touch on broader markets now, the investment landscape. How are you seeing that at the moment? Are you seeing opportunities out there? We've seen listed markets and asset prices in general come off the boil over the last 12, 18 months. So are you cautious or are you optimistic? Are you seeing lots of opportunities out there? How are you feeling?
So I think we're in a really interesting point in the cycle, Mo, and this only happens every decade when you have a real inflection point in markets. And unlike public markets, private markets generally shift over a 12 to 18 month period. So whereas you have a correction in listed markets, the stock price drops the next day by 20%, and you've kind of set the new paradigm for kind of pricing. In private markets, it takes longer, and the reason for it is, for a lot of the vendors of businesses, they're sitting there, and for a lot of them, it's their kind of life's work. So they don't necessarily want to sell at the bottom of the market, but they also can't hold on forever. And I always talk about death, disability, and divorce. There's all these reasons that people need to sell businesses, and they will hold on for a period of time. And generally, kind of vendors or businesses are looking in the rear vision mirror. My mate down the road, he sold his business, he got 10 times EBITDA for it. We're in the same industry, our businesses look similar, I'll get 10 times EBITDA too. Yeah. The reality is the private equity firm coming in is taking a forward-looking approach, and they're saying, well, actually, you know what, cost of debt's gone up, inflation's gone up, margins are down, kind of this is now an 8 times EBITDA business. And so you get this really interesting period of 6 to 18 months in markets, in private markets, where you have almost like this mega buy-sell spread.
Sure.
And it takes a bit of time for that to move. So what you tend to find is the uncertainty that the buyer has tends to dissipate. They get comfortable with, well, are we near the top of the interest rate cycle? Is inflation tamed? So I can pay maybe a little bit more. And vendors generally they lose patience around, I won't be getting 10 times anymore, but hey, this guy's turned up with 8.5 to 9 times EBITDA. It's better than the 8 I was offered at the bottom of the market. And I want to retire and I want to move on with my life. So we're in that point in the cycle, and I think that actually makes for a really good time to be looking at investing in the asset class, because what you're seeing in markets is this reduction in the earnings multiple.
Yep.
I've touched on the multiple and what that means, but also I think it's fair to say the economy's also coming off. So if you think about how you value the business, it's generally profitability multiplied by a multiple. So if you've got a situation where the multiple's down and then profitability is probably not peak profitability these days, people are, pulling back on expenditure, we're not in, rip-roaring economy. So you get the benefit of both sides of that equation actually coming down and being able to buy these businesses at a better time. And I think that's the period we're going into over the next 12, 24 months as we see that resetting of expectations around value, and then probably an economy that's at best treading water.
You've been in this market a long time. You've probably seen a lot of businesses, but you've probably seen just as many investors. So do you think investors need to take a slightly different mindset when they're thinking about investing in private equity versus public markets, or is it much the same? No,
look, it's a very different proposition, and particularly when you're coming into the asset class for the first time. You can't hit Shift F9 and get set in the private equity market in the same way you can in public equities. Really what you've got to think about is this is a long-term asset class. And we might be able to kind of pontificate on what's a good time to be investing or not investing, but what I've always told our institutional investors and our kind of emerging high net worth investors is just kind of think about diversification over time. And we call it vintage diversification. So like, a good wine, you have good years and bad years. We kind of take that parlance into private equity and say you will have good years and bad years, but you need to kind of take a view that you will get to your target asset allocation for private equity over maybe a 3 to 5 year period, because you will need to kind of set money into the market, and then the market, the private equity firm, for example, that you're allocating capital to, will then be looking for the best opportunities over the next 3 years. So I think the view is very much on the entry point, be ready for a 3-year gradual growth in your kind of allocation to private equity. And then you've got to be a long-term investor. You know, kind of, if I think about some of the worst mistakes some of our institutional investors have made and institutional investors around the world have made, is they see a correction in markets and they panic about their liquidity or illiquidity exposure. And so they go and sell at the bottom of the market. So you've really got to take a view that, yes, markets will come and go. I know I've got an allocation in my portfolio which is illiquid, and I'm going to continue to drive that allocation through time, regardless of ups and downs in markets. And I think, if you think about, long-term return profiles in private equity, the best vintage years that we kind of have seen over the last, 40 years of private equity around the world is really coming out of recessionary environments and market downturns for all those reasons we spoke about. Lower earnings profile, lower multiples, you're buying good businesses cheaper, and then you're generally getting an economic recovery on the back end that's helping you with momentum in your investment. So really having that conviction around the asset class when the markets are kind of on the down, that's really probably the secret to success in a private market portfolio.
Absolutely. Look, that's been a fantastic, rapid sort of 101 on private equity.
No, thanks, mate.
I'm not going to let you go just yet. I want to ask you one more question. Just to finish up. Can you maybe tell us, I'll give you two options actually. Tell us about your first investing experience or maybe some advice for someone setting out on their investing journey. Yeah,
look, I've thought about a lot of this stuff over the years and what's the one rule to look for. And, I think at the end of the day, the way I think about it is follow the money is kind of the catchphrase I use, which is, why is a deal being done? Why do they want to take my money? What's the kind of rationale for the seller selling me their equity or their investment? And how are we aligned through that? So, if you don't know why you're seeing an investment opportunity, you got to question why you're seeing it, right? Sure. And so one of the key things that we're always looking for, that I'm always looking for, is why has this deal come to us? Why have they brought us the opportunity? What is it that makes it a good opportunity for us? Who's taking money off the table? Why are they taking money off the table? Is the alignment still in the business? And ensuring that, at the end of the day, if people got skin in the game, they're going to work harder for you. And so having that real alignment of interest and following the money to understand exactly why this deal's being put together is probably the first place I always go, is just trying to sniff out, what is the rationale for this deal getting done.
Yeah, that alignment of interest is a great one, isn't it? Even in listed markets, if you've got management, you've got CEOs who have got some skin in the game, hold shares, they're a shareholder alongside you, then it does make you feel like you're all pushing in the same direction, doesn't it?
Yeah, absolutely. Absolutely.
Well, look, Michael, thanks very much for your time, and we really appreciate you coming across the ditch for this.
So, thanks for having me.
It's a big trip, and all the best and safe travels back.
Great. Thanks, Mo. Appreciate it.